I'm going to break down the most important finance terms you actually need to understand so you can start managing your money smarter. Even if you've never taken a finance class and you feel totally lost when people talk about investing or budgeting, by the end of this video, you'll finally understand what all those confusing money words really mean and how they actually affect your everyday life. A couple years ago, I was completely lost when it came to money. Like, seriously lost. People would throw around words like investing, APY, and compound interest. And I'd just nod like I understood what they were talking about. But honestly, I had no clue. I remember sitting in conversations thinking, yeah, I get it. And then the second I was alone, I'd be like, wait, what did any of that actually mean? I tried watching random finance videos and reading articles, but it all felt way too complicated and overwhelming. Everyone either talked like a professor or acted like you should already know everything. Then I realized there was a simple way to break all this stuff down into plain English. Like, no jargon, no flexing, no trying to sound smart, just normal explanation. Once I finally understood the basics, everything changed. Budgeting got easier, saving actually made sense, and I felt way more confident with my money instead of stressed all the time. And there's just so much confusing and misleading advice out there, so I want to share the simple stuff I really wish someone had explained to me from the start. All right, so here's what we're going to do. I'm going to break this down into 10 super simple parts so you can finally understand the finance terms that confuse almost everyone. And yeah, you don't have to memorize anything. The goal here is just to get it. By the end of this, a lot of the stuff you hear online is going to make way more sense. Step 1, the basics: assets, liabilities, and net worth. Let's start with the foundation because everything else builds on this. An asset is anything valuable you own. So cash, stocks, land, even gold. If it has value and can help build wealth, it's considered an asset. A liability is anything you owe. Loans, rent, credit cards, car payments, all of that. Now here's where it really clicks. Your net worth is just the difference between your assets and your liabilities. So if you own $50,000 worth of stuff and you owe $20,000, your net worth is $30,000. You might be wondering, why does this even matter? Because this one idea tells you if you're actually building wealth or just staying busy with money. Like, you can be making good money and still going backwards if your liabilities keep growing faster than your assets. This is why some people look rich but are actually broke. And yeah, nobody explains this stuff in school. Step 2, income, expenses, and profit. All right, next up, income, expenses, and profit. Income is money coming in. Expenses are money going out. Simple, right? But here's a term people throw around a lot: profit margin. That's how much money is left after costs. So if a company sells something for $100 and keeps $20 after paying for everything, that's a 20% profit margin. And honestly, most people never really think about this when they're spending money. But this explains why some businesses grow and others disappear. It also explains why some people feel broke no matter how much they make. If your expenses grow at the same speed as your income, you're stuck. You're just working harder to stay in the same place. Step 3, stocks, bonds, and index funds. Now let's talk about investing without making it weird. A stock means you own a tiny piece of a company. So if you own Apple stock, you technically own a tiny slice of Apple. A bond is basically a loan you give to a company or the government. They promise to pay you back later with some extra money, which is the interest. An index is just a group of stocks tracked together, like the S&P 500. And an index fund follows one of those indexes. So instead of betting on one company, you're spreading your money across a bunch of them. Quick question: have you ever felt like investing was just gambling? Yeah. This is the part most people don't understand. Most investing isn't about hype or timing or guessing. It's about boring, slow, consistent growth, which isn't exciting, but it works. Step 4, interest and compound interest. All right, this part is huge. Interest is the extra money you earn when someone borrows your money. Like when you put money in a savings account or buy bonds. Compound interest is interest earning interest. So your money grows, and then that growth grows too. This is the thing people call the secret to building wealth. And honestly, it's not secret at all. It's just boring and powerful at the same time. The earlier you start, the less effort you need later. And yeah, nobody tells you that either. Step 5, inflation and why your money loses value. Now let's talk about something nobody likes talking about. Inflation. Inflation means prices go up over time, so your money buys less. If your money isn't growing faster than inflation, you're actually losing buying power. This is why just letting cash sit around feels safe, but slowly hurts you in the long run. It's like a silent tax, and most people don't even realize it's happening. Step 6. Liquidity and why access to cash matters. All right, one more concept that people almost never explain properly. Liquidity. Liquidity just means how quickly you can turn something into cash without losing value. So cash itself, that's obviously liquid. Stocks are usually pretty liquid too, because you can sell them fast. But something like real estate, that's not very liquid. You can't just sell your house tomorrow and have the money instantly. Why does this matter? Because sometimes you don't just need money, you need money now. And this is where people get stuck. They have value tied up in stuff they can't easily sell. So yeah, liquidity is basically about flexibility. And honestly, flexibility with money is underrated. Step 7, ROI and why effort doesn't always equal results. All right, next one, ROI, which stands for return on investment. ROI just tells you how much you earned compared to what you put in. So if you invested $10,000 and made $2,000 profit, your ROI is 20%. Simple. But here's the part people miss. Not all effort gives you the same return. You can work really hard on something and still get a bad ROI. And you can do something boring and get a great ROI. This is why smarter money decisions beat harder money decisions. And yeah, nobody likes hearing that, but it's true. Step 8, portfolio and diversification. All right, next, portfolio. Your portfolio is just all your investments grouped together. So stocks, bonds, ETFs, whatever you put money into. Now here's a word people love throwing around, diversification. That just means not putting all your money in one place. Because if one thing goes bad, everything doesn't blow up. And yeah, it's boring, but boring is kind of the whole theme of good money decisions. Step 9, ETFs and why they're popular with beginners. All right, one more super common one, ETFs. That stands for exchange traded funds. Think of them like a basket of different investments bundled into one. So instead of buying 50 different stocks yourself, you buy one ETF that already owns them. Why do people like them? Because they're simple, low cost, and less stressful. And honestly, less stress is a win. Step 10, market cap and what big companies really mean. Last one for today, market capitalization or market cap. Market cap is what a company is worth in the stock market. You get it by multiplying the stock price by the total number of shares. This is how companies get labeled as small cap, mid cap, or large cap. And this matters because size changes risk. Bigger companies are usually more stable. Smaller companies can grow faster, but also crash harder. So yeah, big company actually has a real definition. So now you finally understand what assets, liabilities, net worth, income, profit, stocks, bonds, index funds, interest, compound interest, inflation, liquidity, ROI, portfolios, ETFs, and market cap actually mean in plain English. These aren't scary finance words anymore. They're just tools you can actually use to make better money decisions. And honestly, that alone already puts you ahead of a lot of people. If this helped, subscribe for more videos just like this.